Welcome to DF Markets Forex Basics. Reading currency quotes. If we're looking at a quote for a currency pair such as EUR/USD, this shows us how many dollars, which is the quote currency, it takes to buy €1, which is the base currency. This means that if the price is 1.11, it takes $1.11 to buy €1. If the price on the chart is 1.30, that means it takes $1.30 to buy €1. So whenever you see a currency quote such as GBP USD 1.25, that means it takes $1.25 to buy £1. And if you see USD JPY 115, that means it takes 115 Japanese yen to buy $1, because this time the USD is the base currency and JPY is the quote currency. When you open a new trade and decide to buy or sell, you are buying or selling the first currency in the pair. So if you expect the GBP to go up on the US dollar, you would buy. If you expect the GBP to go down on the US dollar, you would sell. What is a pip? PIP stands for price interest point, or percentage in points, and it represents the smallest possible change in a currency pair. A pip is always the fourth decimal place when you're looking at prices your broker gives you. However, for some cross pairs, brokers will include a fifth decimal place, which doesn't actually affect the price, and it's called a pipette. So if the quote is EUR/USD 1.1105 and the price changes to 1.1106, price is increased by 1 pip. If the price moves from 1.1105 to 1.1100, price has dropped by 5 pips. Essentially, in the major currency pairs, a pip represents 1/10,000th of a US dollar. In pairs which include the Japanese yen, a pip is 1/100th of a yen, because the yen is actually closer to 1/100th the value of other major currencies. What is spread? Each currency quote consists of two sets of prices. The price on the left is the bid price, which is the highest price the market will pay, and the price on the right, which is the ask price, the lowest price the market will sell. The difference between these two prices is called the spread, and it is essentially the broker's profit on the transaction. The higher the liquidity of the pair, the tighter the spread will be. In the example below, the bid is 0.7565 and the ask is 0.7566, so the spread is 1 pip. What is a commission? Commissions are another transaction costs, like spreads, which your brokers charge. These rates can be fixed or variable, and some brokers don't charge commissions at all. What is a stop loss? A stop loss is a predefined level at which your broker will automatically close a losing trade for you. So, for example, if you buy AUD/USD at 0.7566 and want to risk 50 pips, you would put your stop at 0.7516. If the market moves down to this level, your trade will automatically be closed. Using a stop loss means that you can control your risk on each trade you place, and importantly protects you against any adverse market moves around risk events and any unexpected market developments. What is a take profit level? A take profit level is the price at which your broker will automatically close a winning trade for you. So for example, if you buy EUR/USD at 1.2345 and want to target 158 pips profit, you would put your take profit level at 1.2503. If price reaches this level, your broker will automatically close the trade for you, realizing your profit. This function is especially useful for trades left on overnight, as it means you won't miss exiting at your target.